Hello everyone. I'm going to just take this time to try to make sense of the things happening in the economy right now, which are kind of crazy. The coronavirus and the big drop in the stock market. I'm going to relate it to the things we covered in class, and I'm going to try to see how we could use our course material and our course concepts to make sense of what's happening around us. So let's take the stock market. Now we had a big fall in the stock market, right? We had the biggest point drop in history, and the stock market fell 260 points. Now, and we're measuring the stock market by the way, the S&P 500. There's another popular measurement of the stock market called the Dow Jones Industrial. Most economists and most analysts prefer to use the S&P 500 because it covers, well, 500 companies, and the Dow Jones Industrial only covers about 30 companies. So it's a more broad measure of the overall stock market. Now, one thing you have to realize is the point drop is not the only way or necessarily the proper way of analyzing how significant a drop this is. What you have to do is you have to look at how big of a percentage is this drop of the overall value of the index. And you could see here it's a 9.5% drop in the overall value. Now what I've done here is I've contrasted the drop here. So that 9.5% drop is just the recent change, and that recent change is about this area right here, right? But you could see I highlighted the high point of the stock market, the recent high, and where we are right now, the low, and that measures a overall drop of 27% of the overall value. So even though we fell 9.5% today, the stock market since its recent high has fallen 27%. Now let's look at the time where we are studying in our history class of the financial crisis. Here you could see I've highlighted a significant period, the bankruptcy of Lehman Brothers, which happened in September of 2008, specifically to September 15th. And you could see I highlighted the high and the low, and you could see the stock market fell 47% compared to the 27% we see over here. Now the biggest point drop I think was only about 60 points, but that 60 points represented in some cases a larger percentage of the level of the stock market than the 260 point drop that we saw recently. And what I've done here is, let me scroll down. I've listed the top 10 drops in a day for the stock market in percentage terms, and you could see the big one was in 1987, and that was a 20% drop. Now notice how the point drop was only 57 points, but that 57 points represented 20% of the overall value of the stock market. So that's significant. Here we are right here. You could see that our today ranked 5th in the overall drop, at that 9.5% drop and this 260 point drop. So notice how this 260 point drop is by far the biggest drop in the top 10, but it doesn't rank as the top percentage drop. Now what does this mean in terms of the overall economy? Well, let me scroll down. Let me get some blank white screen. Okay, I got some white screen. And let's just use some tools what we've covered in the class to analyze how does the coronavirus and the stock market impact the economy. Well, first of all, we measure the economy by looking at economic activity. And the activity we use to represent the economy is output. And so that's GDP. GDP, gross domestic product, is the value of all output. And the value of all output is you look at the output Q for quantity, and you multiply it by the final sale price to get the value of all output. Now we could use supply and demand to help us analyze this. And we'll look at the supply for the entire economy. We call that aggregate supply. And the demand for the entire economy, we call that aggregate demand. And you can see where they cross, that's going to give you the equilibrium level of output and the level of, equilibrium level of prices and the equilibrium level of output. So this is economic activity right here, the level of output. Now, what happens is when the stock market falls like it did, a huge chunk of wealth is erased. So people are less wealthy. And this has something we call the wealth effect. The wealth effect is when people have a fall in wealth, it changes their spending habits. They spend less. If you spend less, that means you demand less. And the demand curve, aggregate demand curve, shifts to the left. So this is AD1. And you can see this leftward shift causes a new equilibrium level of output, which is lower, and a new equilibrium level, price level, which is lower. And this is basically showing a contraction of the overall economy. Now, we could have a double whammy in terms of the coronavirus, because not only are people staying home, workers are staying home. And this is going to have an impact on the demand for goods and services made for businesses, which is going to have another impact of aggregate demand. And it's also going to change supply. If we can't produce as much, the supply curve is going to move this way. So let's say we move to another point here. Now the supply curve shifted. Now we move over here. And you can see this is causing economic activity to contract even more. And this is what you would call a recession. When you have a sustained drop in economic activity, at least 6 months, you have a recession. Now, we're not in a recession right now, but it could start if this sustained drop in output continues. So this is a way for us to try to make sense of how the stock market crash and how a coronavirus causing people to stay home, not work, and not spend impacts the overall economy. So I would love to hear your comments or read your comments. So please, you could comment below or email me if you have any questions. That's all for now.